Does anyone want to give a go as to why the average measure of the Australian stock market is nowhere near the peak of where it was pre-GFC? I mean, we haven't even got close to 6,800 points. We're 62, 63, 64. But yeah, nowhere near 68. And fundamentally, yeah, there's issues with the Australian economy, but there's plenty of money around. But it's just nowhere near its peak.
That's the earnings. That's the earnings that backs the market. So in terms of dollars, literally just if you just add up all the dollars that it's a bit weird. So basically, you add up all the dollars and then you put it on the same basis as the index just to get it all right. And so you can see we peaked at sort of whatever that is, 13 cents worth of EPS, and then fell back to 13 cents. And since then, we're back down at sort of 10 cents of EPS. So dollars behind it is a big one. The other thing that is, it's not insubstantial over a longer period of time, is that the Australian market pays a much higher level of dividends because of the franking. So what tends to happen in the US is they pay out a similar amount of dollars, but what they do is, maybe a third of it or a half of it goes into paying dividends, and the other part goes into doing buybacks. And what buybacks do is they increase the share market by say, let's say in Australia you're going, I'm taking 5% every year and giving it back to shareholders, whereas in the US you're basically saying, I'm giving 2% to shareholders, and 3% goes into increasing the share price. And so it doesn't sound like much in 1 year, but you aggregate that up, and so on a total return basis, it doesn't look as bad. But yeah, that one's the key reason why we're still lower.
I mean,
I'd say
the peak in 2011 is equivalent, but again, if you look at the average, the average of the industry is nowhere near where it was, especially in 2011.
Yeah, that's because everyone was sort of. I think there's some great graphs of analysts tracking, forecasting commodity earnings, and basically at that top peak there in 2007, analysts had it forecasting to double or triple over the next few years, and it fell by 80% or something like that. Like it was, and then this next dip, the next peak, people were like, oh, it's not going to go to infinity. It is actually going to come back at some stage. So yeah, that's where you got a lot of that.
the other thing is we've got a very profits challenged economy now. Heavily concentrated oligopolies everywhere. A lot of empty calorie growth for its own sake, which benefits very narrow segments, while everybody else kind of picks up the tab.
Telstra's a great example of that.
Yeah, I mean.
So my example for Telstra was, Telstra's share price has been sinking for years, and then in the last couple of weeks we've had this suddenly popped 15% because TPG is merging with Vodafone. It's like, oh great, a comfortable oligopoly again. We can get back to just taking money from customers rather than having to compete.
Yeah.
So we don't want those people. We don't want TPG in there driving prices down. We just want everyone to sit back and just put our price rises in every year.
So I mean, the economy's just been managed for very specific interests for a good decade, if not more.
It's getting worse too.
Not for productivity, not for income gains, not for increased profitability. All the measures that you would expect to see in a healthy economy. And the boom we've got going right now, right? Lots of jobs, no wage gains. We called it the Botox boom because it's almost entirely profitless.
Fake.
As you can see, profits are falling in the middle of this 3.4% GDP boom. It's all fake. It's all managed to give perception of great growth, to sustain the no recession narrative. All of it managed to make the headline numbers look great, but underneath the bonnet, it's a stagnant dog. And the Botox boom is classic. Terrific growth going absolutely nowhere.
And you can see at the household level where you got the savings rate has fallen to the lowest levels since the financial crisis, 1% now. And that's what's holding up consumption. And that's holding up consumption because real wages are still falling. So there's obviously limits to that. It's not sustainable, and that's kind of where the rubber hits the road at the household level.
Yeah. And that to me, that's where all this political instability is worldwide as well. This increasing inequality and stuff like that is when you have people stand up, you've got treasurers and government stand up and go, 3.5% growth, you guys have never had it so good. And people look at their wages going, I haven't had a pay rise in 3 years. I've had it better than this.
Yeah.
That's where you get the part where,
8 actually.
yeah, they're not, people aren't stupid, or, well, in a certain sense, they know something's wrong. They don't know what the answer is. In America, they decided the answer was Trump, you know, but the thing is, they know something's wrong, and they know doing more of the same isn't going to help, which is why I think we're seeing Brexits and we're seeing, you know, rise of all these fringe parties, and people just, it's got to be something different, you know.
Yeah.
So I have a quick question. Which of the fund options that you have is the best hedge against what you guys are just talking about? Like which one?
Which?
Like, if we were to subscribe to that. It's kind of
So our growth fund takes the most amount of risk. So we'll you know, longest overweight. The other funds are more there for blending usually. So they're very low risk versions. And so basically we're trying to say how much risk do you want to take and how much income do you need? And then we'll sort of blend the 3 funds to try and get something sort of tailored back to you. But the growth fund takes the biggest sort of swings, and then and the themes that sort of play out the most in the growth fund, and then the other ones are sort of conservative echoes, I guess, of those themes.